Dumb, dumb, ladies and gentlemen. It's the end of the week. That is a triumph. This is the acid breath. It is October the 17th. And we got to get into it. I've got to get my head sorted. I've been sitting here on a Friday, procrastinating. Can't quite get. I'm a jumble of thoughts, and the responsibility for that, of course, rests on my shoulders. But the responsibility is gold. Gold. You're making me old. You came in and you defined the beginning of my hedge fund career. You made me into something. You asked me to suffer. I suffered willingly. In my first calendar year, I was like a restaurant with a fire in the kitchen, and I had grumpy customers. I wasn't sure if I was going to make it. I had big drawdowns, especially in the month of, I think, March of 2003. But gold, you rewarded me, and I thank you. And we were $300 back then, you and I. And look at us now. I'm wearing a silver ring, not a gold ring, but I'm in St. Bart's, baby. I got the house. And what have you got? You've got $4,300. Can we believe that the Bank of England sold 55% of its reserves back then? Wow. But I think gold, my dear beloved friend, I think this is where we part company. Because I'm no longer excited about you. And probably that reflects my weaknesses and my foibles. Do you know that word? Foibles? Why does it come out awkwardly? Why do so many words come out of my mouth awkwardly? Anyway, let's do the introduction. Let's play the music. Let's get into it. My sisters, my brothers, the gold lovers. Everyone loves gold. I don't know what brought you here today. There's about 1,800 hardy souls, and I love you every day. You brush your teeth. I don't know what you do. You're in the car. You're walking the dog. You're making breakfast. You're hearing me cough. And I so appreciate it. I'm so glad you show up every day. I watch that count. Every day I worry about anything, but my listeners are my new message to myself. Let's calm down, Hugh. Let's take the acid breath. In through the mouth. Let's do box. In for 4. Out for hold for 4. And then out for 4. Let's just calm it down. The words will come. The words always come. And I have to say, I find this a remarkable exercise. I sketch little routines in my head. But I'm never sure. Sorry, forgive me. I you're listening to me. If you could see me, I glow like radioactivity. It's the coconut oil. Very taken by coconut oil. I put a high refined blend of coconut oil called MCT into my coffee, and it dials up my brain. I use it as a moisturizer, and does it have a sun filter? Not really, but I use it as a moisturizer, largely in my neck, my chest, my arms, a little bit on the face. I gargle my teeth. I don't gargle with it, but I kind of like meditate. I take about 10, 15 minutes before doing this. I have coconut oil in my mouth for 15 minutes. It's a morning practice as well. I'd also recommend it as a lubricant for those of you who are sexually not adventurous, but engaged in such matters. Anyway, self-edit. Let's speak in a composed manner. Maybe you just stumbled in and you're thinking, what the fuck? You've definitely found the sound of chaos. This is acid breath. And that's what I do around here. I kind of stick my finger in and I prod and I try and find chaos. I look the market in the eye. And I've been looking the gold market in the eye and recently I've been looking at in the anus because it's just rising above me. Weird metaphor. As you know, this is a podcast with no filter or script. I'm here to tell you about my engagement with the world, how it feels, and what moves me. Anyway, shall we begin? Has that music stopped playing? Don't you like that music? Are you getting fed up with that music? Again, fan mail, let me know. Fan mail. I got something in about two hours ago from us. I don't know if is it from Australia? But I was mentioning that panic on the streets, people queuing up in some metropolitan area, queuing up for a long time, it would seem, to buy gold bullion. Just where was this crazy scene from? And fan mail, someone, a friend of the show, told me it was in Sydney, Australia. Told me that there's a great cynicism about the value of currency. I get it, but queuing up and buying like a gold coin, you probably have to queue to sell it back. You know, it's not wise. People are not being wise. But thank you for the engagement, and I would welcome more emails. Give me your thoughts. Give me your 5-star rating. Sponsor the show. Come over to Substack. The Substack's really solid. You know, I, believe it or not, but I will carve an essay out of this. I will do that tomorrow. I will have charts and I will have further observations, and then we'll have the video. I'm probably going to post yesterday's video of the podcast on Twitter and YouTube, just so that we can spread the message and try and get more members of the tribe. I have been experimenting with a black and white, the jazz feel. I've been experimenting with my goggles. Yeah, I come from the future and sometimes there's a glare and I have to wear these goggles. I've been experimenting with the presentation of that on various social media channels. And unfortunately, they were all very conservative. And my black and white, the engagement statistics are not as good as just the plain color. So maybe it's just going to be color. And I've taken my goggles off. For how long remains to be seen. And I started a podcast about 17 days ago, and to discuss the economic data releases from the largest economy in the world, the $28 trillion American economy. Oh, that reminds me. And I'm back. Am I recording? Yes, I seem to be recording. Just wanted to lower. I've got a knob. Don't we all have knobs? I've got a knob on my control panel for the sound out, and there's a high knob, and I wanted to reduce it a little bit. Yeah, irony and paradox. As a hedge fund manager, I made it a point of ignoring economic data, and now I've started a daily podcast to discuss economic data. Go and make of that what you will. And of course, that's coincided largely with the suspension of the publication of the economic data because the US government finds itself closed. The economy, of course, is not. And it would seem as Halloween approaches, there are skeletons almost everywhere. 17 days now. So I thought I should maybe kind of like be a little bit analytical. Let's talk. I mean, there was no economic data. I mean, remember the day when we got CPI? Remember the day I made up that day? Remember the day we used to have retail sales or jobs? God, I hated the jobs day. Or industrial production. We get none of that now. And for me, that's bliss. We don't have mediocre guys, middle-aged white guys in suits on television talking to other middle-aged, mediocre people who are pretty much clueless when it comes to wealth creation or the procurement of wealth, talking about numbers to 2 standard deviations and numbers which will be subject to enormous revisions in the future. That circus, that clown show is presently suspended. And all we're left with are whispers. For me, my question is, I think this is what sanity sounds like. You want to understand the economy? Get out there. You talk to people. Get off your phone, look around, raise your head. Raise your head. Smile, breathe. The essential services in America are limping on. Essential, air traffic control, border agents, active military, still working, but actually unpaid. They will receive back pay. Many others, 2 million, of course, will not. Museums are closed. Maybe museums, I mean, they're all these rich folks and they're donating money for tax breaks. Maybe they should just run museums. Does the government have to run the museum? Don't know. The Inland Revenue Service it's stopped doing tax audits. Interesting. The FDA is no longer inspecting drugs. Infrastructure spending, especially in the Democrat areas of the American economy, they've been put on hold. But did I mention this? Sorry, my mind's kind of flat. But the longest shutdown, I think, was 35 days, and that was when there was a certain President Trump won. He got to 35 days. The brother just brings trouble. He likes it. If I got your attention, we're closed. Yeah, 35 days. That was 2018, 2019. And 21 days was the previous inauspicious record. I remember the days the Republican opposition leader was that curious character, Newt Gingrich. Sounds like a frog. Bill Clinton, of course, was president. We have another Senate vote, which awaits us on Monday. I don't think we're going to see anything. I think they're going to push it. Thanksgiving, maybe. Thanksgiving's kind of when St. Bart's really starts to pick up. Punchlines. Do we have punchlines? No, we don't. What do we have? We have more and more people are talking about the Treasury market, the TLT. I'm probably going to get my balls roasted double time over, having been 2 years early. And, it was like late 23 when the bonds just, they've been erratically horrible and kind of gone mostly sideways, but kind of touched lows over that period. And I'm not in it just now. For a mean reversion, I think it looks incredible, but my discipline is that I have to buy things going up. So I'm looking for the spot price to be above the 1-year moving average and for the 1-year moving average to be trending positively, which is to say, I will be later than some of you in buying those Treasury positions. But they're getting a little bit of a buzz. And today it felt like the Treasuries were regaining a kind of memory, a kind of reflexivity. They were looking at the regional banks, or do I call them the fews? KeyCorp, Zion, more banking earnings. This time provisions, loans not really going well, subprime autos, credit cards, to add to the litany of woes, which of course is commercial real estate. And the deep undercurrent, I put a tweet out today, again, celebrating Steve Miran, the new Fed governor, but very much I see him as the architect, the intellectual architect of the great and very positive, those are my words, changes that I see in the administration of the US's thoughts and philosophy with regard to economics. And Steve's big point is politics. We had historically, there's the adjective that comes to mind and it seems appropriate, a surge in the demographics of America, a surge of over an impulse of more than 1 million people a year coming into the country. And not overwhelming, but overwhelming in certain areas. Things like the demand for apartments, the need for a car to get to work, a used car, a rather cheap apartment, probably in a complex, and the need for a bit of credit until the paycheck arrives. And this legal and undocumented flow of people, Steve's point is it kind of reshaped the economy where it touched it. And of course, the touching would be in housing. And that takes us into this parallel universe where the Fed, rather than measure house inflation via the rate of change in rents, house prices, what have you, now is way too clever and smart for that. And it creates a model. And the model is very much like a machine. It looks at the past and it weights very much the recent past. And this recent past, if you will, is contaminated by what was the surge in immigration. And therefore a surge in demand for housing stock. And so Steve's fear is that the measure of Switzerland, why can I not say things without being silly? Switzerland, what am I talking about? Neutrality. The neutral, the Swiss rate of interest rates, the rate of neutrality, the rate where you're neither trying to force the US economy off a cliff or you're trying to push it back up to health and vitality. The neutral rate where it's like, yeah, we're neither here nor there. We're on pause. We're like, yeah, we're neutral. We're beige. That's estimated roughly around 3%. And that 3%, or that neutrality, they call it R squared. Let's keep finance as art and not as science. But that 3% beige rate of policy rates, the private market at large, those who hedge, those who speculate, those who run a giant passive and aggressively traded funds. The sum of all their knowledge and their engagement is that the Fed will be at 3%, i.e., it will be neutral with regard to its impact on the economy at the end of next year. And Steve's point is like, yeah, I think you're wrong on that. I think the neutral rate is way below 3. And if you persevere with these dot points and you find yourself at 3, you will, with error, not with intent, but you will probably have caused a costly and an unnecessary recession in the United States of America. And those points, he made those points in his introductory speech as a new Fed governor. Slammed by many people, not by I. But since then, of course, what have we seen? We've seen a flare coming, a flare from, if you will, subprime credit. Again, where the undocumented migration touched the economy. Auto loans in particular. And we're seeing bankruptcy. Tricolor is how you pronounce it, which would be very much at the front and the forecenter of that activity. Car loan financing for used vehicles. CarMax, I discussed that yesterday, largest retailer of used second-hand cars. They're really feeling it. And of course these parts of the economy which had this influx, this disturbance in their universe, required capital and fresh forms of capital to sustain what they were seeing. Like I say, like Steve says, effectively you squeezed 50 years of demographics into 5 years, which has disturbed and warped perhaps the Fed's dashboard. It's got to maybe pressing brakes too much. But on the other side, if you are the entrepreneur, if you're the business, that's a huge surge in your business. That's a huge endorsement, an endorsement for you to expand your footprint. And typically that requires capital. And that was coinciding with innovations in the financing from invoices, credit funds, a larger pool looking to lend non-specific, non-generic risk, which then brought in this notion of Gresham's. That was successful. And it was pulling business away from America's regional banks, which kind of are withering. They really are increasingly lacking any purpose, any raison d'etre, any reason for being alive. And so they panicked and they came in saying, oh, no, we're not giving this up. And so lax underwriting standards, lax underwriting credit standards are bad money. And Gresham's law is the notion that bad money will push out good money. So bad credit lending standards will usher in a period of a credit expansion, but ultimately loan losses, which is what we were seeing from some of the regional banks and their earnings today. And briefly, we had treasuries again below 4%. Memory. This is all Steve's point. So that this week, is this a recap? But I'm thinking about that. Stocks, looked a bit soft and certainly looked soft at points in the week, but kind of recovered. I have to say this, the S&P, the American indices, they They feel like what is that? Is it fairy tale? The little Dutch boy, and he's walking home, and in Holland they have these. They're not dams, but they reclaim a lot of the sea and make land. And there was a dike, which is kind of, I guess, like a dam, and it's leaking. And he puts his finger into the hole to hold it. And this week feels like a finger in the dike. We bought a week, nothing more, nothing less. We'll see what next week brings. As to be said, however, on the other side of the world, Japan had a stonkingly good week. Stonkingly good week. And, markets look astonishingly kind of vertical on the basis of that, of where they came from the lows of April. But, year to date, S&P up 13%, the Dow up 8%. It's not gold. We'll come back to that. Why don't we do gold now? So I was kind of like, what am I missing? And I'm curious and I'm nervous. So what am I missing? And why is it affecting me? Which is a great question. It's affecting me because my reason for being a speculator is to participate in profound uptrends. And gold presently has a profound uptrend. And as a professional investor, back in the day, my point was emotional intelligence. I don't need to fully comprehend why it's happening to participate. And that remains the case. And so I would be in gold. But how much would I be in gold at this point? That's my problem. That is my problem. How much would I allocate to this? What is the most profound trend in global markets today? The gold price. And why can I not? Normally I've got a cute theory. So I went looking for cute theories and I came across something which I was unfamiliar with. And it's a celebration of another, I don't know if he was cookie, but of a chap called Jim Sinclair. And he saw the future through gold. And he wasn't a trader. He wasn't a digital coder. He was a 1970s guy. A decoder, perhaps. Perhaps that's what you call them. And there's the Sinclair thesis. There's a lot of Aussies and the like who listen to the show, and I'm sure you're all rabid gold bugs. And so I'm sure you're like, oh, Jim Sinclair, and you're yawning. But for those of you who don't know, Jim believed it, and he posited a view. And he posited, so he made his argument on an ex-ante basis. So in the 1970s, gold, of course, was freed from the tyranny of having this fixed price at $35 an ounce, and it was allowed to freely float. And then we saw the adoption of what I call fractal reserve banking, where you introduce futures. Probably didn't introduce an options market. I don't think we were as advanced back then, but futures. And so you are expanding the amount of tubes, if you will. You're connecting the asset class into the wider frame of pension funds. It wasn't really private equity back then, but pension funds, passive funds, endowment funds, retail, family offices. These tubes were making that market more accessible. And the more money that comes in, the more comforting and liquidity and being able to trade size. And so size gets bigger and the whole thing's a virtuous circle. So during that period, what's he called? Jim Sinclair. He posited that the gold price, and again, what did he posit? Hold that thought. Hold that thought. So the whole notion of having a freely floating gold thing was new back in Jim's day. Started in 1970. And so no one really had to ask, what is gold worth? Yeah, because when you create a market, you get a market value, and then, is it when you get things that trade, then it's, hey, is it fair value? Is it overvalued? Is it undervalued? What is it worth? And so Jim took that on, and he kind of, I guess, using Milton Friedman work, he posited the view that the gold price should mirror America's external debts. That it should have 1 ounce of gold in the official reserves for every foreign IOU. So explicitly, it was a very simple calculation. You take the US external debt and you divide it by the official gold reserves. And I believe that those gold reserves have not changed. Looking at my computer there. America is the largest. Its reserves are the largest in the world, the largest of the sovereign reserves. It has 262 million ounces of troy ounces. And look at this, actually. Well, you can't. Well, I'm showing you things through the speakers in your ears, but I'm holding an ounce of silver. Can you see that? Can you see what it says? It says, "I recommend you panic." I deserve credit. That's such a great. That should be put on the tombstone of the gold market, and yet it's on an ounce of silver. If it was gold, I think it would be half the size. I recommend you panic. I recommend you panic if you've got over half of your wealth in gold. What the hell are you doing? Anyway. So he took the IOUs, essentially the foreign liabilities, the government's treasury liabilities, which were in the hands of foreigners. He divided it by the 262 million ounces of gold. Now, I know some of you folks are cranky, and social media and dopamine and foreign sleaze operations out of China and Russia, they agitate your mind, and you probably believe that there's no gold in Fort Knox. That is the road to ruin. It will not take you to the promised land thinking like that. I literally don't care. What I do care about, and first and foremost, I see this as a celebration of Jim Sinclair. Came up with a theory, trying to fill a void in this new market, asking these existential questions like a child, like, where am I from? Why is the sky blue? Where should gold trade? And so he chose the US as the largest economy, and the economy that had been the reserve anchor with its gold reserves. They said, right, okay, well, we have to be confronted with the notion of crisis. And if foreign belief in the fiat system crumbled and those debts were to be repaid, then a recourse would be those 262 million ounces. And so let's divide one by the other. And in doing so, he got a price target for gold of $900. And I think he did this maybe in 1976, 1977. And by 1980, January 1980, gold hit $850. And to the man's great credit, he said, boom, $850. He was I'm not a decimal point guy. $850, kind of $900. I'm out of here. And then he paused it. I'm not sure I should have looked that up. That annoys me, but I'm not sure what it was. But he got what I would call the willies, or he got a sixth sense. He started seeing dead people, and he's like, gold's going to correct. It can't stay here. It's kind of how I feel today. And so he recommended. He said, I recommend you panic with regard to your gold position. And more than that, he had accumulated a speculative long position in gold. And the profits, and there were profits, he realized that trade. He sold all of it at $850. And in today's terms, he made 45 million. Fantastic. Well done, Jim Sinclair. And so the argument is, let's do it again. Like I said, those gold ounces remain the same. Those gold ounces at today's prevailing 4,300 price of gold gives you a cool $1 trillion. Context, China. You're all excited because China's accumulating. Where is China? The value of China's gold holdings is $300 billion. 300 divided by 18 billion economy versus the US with $1 trillion divided by a $28 trillion economy. Anyway, the US, of course, has liabilities. Foreigners hold about 10%. Not 10%, they hold about $10 trillion of treasuries. And so you get a calculator and you go 10 trillion divided by 262 million troy ounces, and you're confronted with absurdity. You get a target price for gold of $36,000. That, I'm going to be bold, because normally I try and hedge things with the caveat that anything's possible. I've lived a long enough life. I've seen a lot of crazy things. Gold is not going to trade $36,000. And if that has you choking on your toothpaste, I apologize. And you're right to scoff, and I'm not proud of myself for saying it, but there's a point in your life where you've got to be opinionated. There you go. That's my opinion. I think that's ridiculous. Ridiculous. I can't fault the maths, but I want to fault the logic. What is the value of gold? What is the market valuation that gold commands today at 4,300? That would be an interesting question. And so to get there, I think it's commonly accepted that we have extracted from the Earth's crater 7 billion. I keep saying troy. I hope that's correct. Troy ounces. What is the difference between troy and metric? Let me know. Send me an email. And there's about another 1.5 to 2 billion of proven and provable reserves, if you will. It's the Bitcoin and the 21.5 million coins. It's there. We know it's there. We know we can get it. Gold today on that metric is $39 trillion. S&P is $56 trillion. Are you telling me that gold's going to trade $36,000 per ounce, which would be essentially $300 trillion? And $300 trillion is the size. Paul Tudor-Jones was on CNBC this week, and he was maintaining that global financial assets, was it global, was it American financial assets, are $300 trillion. I don't see it. And give me a choice, S&P or gold. S&P or gold, S&P or gold, S&P. Why? Because I've got a risk premium. I'm being paid to hold it. If you take the S&P total return series and you start with $1 back in 1970, and you do the same with gold. Now, gold doesn't have, it does not have any income. And when you miss income, even a very small amount of income, because we're talking about 50 years, 55 years of compounding, even 1% is going to compound into something significant. Anyway, that dollar invested in the S&P with dividends and share repurchase and everything else is $256 today. And the gold is half that, but 125. I mean, well done, gold. And there have been moments. Let me see, I want to look at this. There have been moments when the return from both have essentially been the same. Let me have a look at that on my screen. Let me try and describe that. So starting with this dollar invested in 1970, the 1970s were a poor investment backdrop for equities. They largely went sideways with huge drawdowns, whereas gold, as I say, went from $35 to 850. And so stocks were in the deficit, were playing catch up versus gold. And you had to wait until the early 1990s for the total return from the S&P to have matched what gold had achieved. So kind of 22 years into the game, stocks caught up. Now remember, it's all about where you start from. The starting point was a profoundly low base on gold. And so it should have, if you will, have done well. It's a bit like today, people show you those preposterous charts. And they're like, hey, you should always king gold. And they'll show you gold from 1980 to present. Again, that's one of these artificial, not from 1980, forgive me, from 2003. 2003, gold was trading at $300. And 22 years prior to that, it traded at 850. So 2003 was very much a bit like taking a comparison with 1970. Okay, so we're got to be very careful on your starting points. The starting point of 1970 favored gold, and it took equities 22 years to catch up. And of course, boy, did they catch up. And gold was just shocking. You then needed, but you then, like everything else, you got mean reversion. And so gold, like I said, bottomed in 2003. And well done, gold, because like 9 years later, now what was happening? The S&P suffered a bubble and crash at the turn of the century. And then we had the near insolvency of the global financial community in 2008. That was wonderful for gold. And that allowed gold to catch up. And so in the end of 2011, early 2012, the total return from gold pretty much approximated the same return from equities, despite equities enjoying that favorable win from the risk premium. So 13 years ago, the returns were identical from that starting point. And since then, what can I say? Since then, So since 2012, stocks again have outperformed because late 2011 was gold had doubled in price from 2009 with the advent of quantitative easing. And this kind of supposition that we would rapidly see monetary inflation and the debasement of the fiat dollar. That did not happen. And so gold went sideways for the best part of 10, 11, 12 years and has only recently taken off again. So what can we conclude from that? Is gold, I mean, maybe it's possible, it's quite possible that stocks have a correction. And if we fast forward ourselves, I don't have my goggles on today. Where are my goggles? My goggles are somewhere. Hold on. Should I put my goggles on? A different pair of goggles. I'm putting the goggles on. Screw it. I love the goggles. Okay. If we're sitting here 3 years in the future, this chart, and I will share this chart on to the Substackers, maybe the gold has caught up with the S&P again. And that will be the third moment of historical engagement where returns from competing asset classes is that normalized, or they've matched each other? That is very feasible. I think that would be a function of stocks falling precipitously and gold less so. I think that would be an environment where you would lose money in both asset classes. But I don't wish to be. So be it. That would still be called winning. And this, I think, would be called wearing your goggles upside down. Are my goggles upside down? Or is that just what they look like? These are random fascinations for people who are listening on headphones. Anyway, so so why am I not just sucking on the pipe, the bull pipe, with the gold? Why am I being so tough? Actually, why am I being so tough on these goggles? Actually, the rubber, something I think is eating the rubber and it's eating my lungs, and I've got a lot of flex. Anyway, I'm back. I'm concentrating. Why am I dismissing the Sinclair model? And Sinclair model kind of had a relevance back then. I mean, remember, this was hypothecated almost 50 years ago. And so we were in the early stage of moving away from a gold standard. The Sinclair model, Fisher-Sinclair model, seems to describe an environment that would be very appropriate in the 1920s. But it has not been appropriate for 50 years. We are not on a gold standard. And like I said, the valuations you get are just insane. And really, like, no one's going to want to own Treasuries or own the S&P. No one's going to want to own Nvidia. No one's going to want to own Apple, Google, Microsoft, or more appropriately, the future generation of such names. They are simply iterations of IBM. There will be something else that emerges from that innovation. And the frustration, again, and what's stopping me from getting it, is the Trump administration. The policy pushback is everything you want as a hard money aficionado. It's not everything, right? So, because you had that stupid big fat bill. But the steps they're taking are, you've got an administration that wants to tame the spending. You've got an administration which recognizes that non-engagement meant that you were held hostage to sovereigns that don't share the same vision of democracy as you do, and that by doing nothing, that the other side's policies dominated, and that you actually ended up having to take on more and more of this debt, this foreign financed and indeed domestic debt. Remember the whole notion, the savings. And again, there was another email that came in for someone enjoying the show. Thank you very much, my friend. And talking about how he much appreciated, I think it was around about 2017, and I began to hypothecate that we were entering a period ushered in by quantitative easing, a period that would reward the creditor. No, forgive me, the opposite, that would reward the debtor. It was the debtor's turn to shine. There are two agents in the economy, the debtors and the creditors. And the creditors have done really well. The creditors are countries with huge current account surpluses, like the Saudi Arabias and the mercantilists. A lot of money, they don't know what to do with it. And the debtors are where all the action, where all the excitement, where all the pretty ladies reside. It's the Steve Jobs, it's the NVIDIA guy. It's the guys who are shaking things up. And they start poor and they end up really rich, but they need financing. So at a sovereign level, creditors Saudi Arabia, China, Japan. And I've tried to arch. If I try to arch, am I arching? I'm not arching. I've tried to explain that the Trump administration is now, we're at war with China. Presently, it's an economic war. But that war became very necessary with the revelation from the pandemic that America had outsourced absolutely everything, and it was profoundly vulnerable to conflict. And that revelation has coincided with, we don't get industrial revolutions anymore. We get technological revolutions, AI and automation. And whoever owns and excels with this revolution will be a winner takes all model, a bit like there is only one Amazon. There is only one Uber. There is only one, web browser, really, etc. Will there only be one AI? Don't know. But there will kind of be just one preeminent sovereign hegemon. And the US wants it to be America, clearly. And a blessing of that is that it allows, from a cost perspective, to onshore. But the costs, I was talking about Taiwan Semiconductor yesterday, which is doing $40 billion in capex, and it's a $1.3 trillion company. But we got Meta, which I think is $2 trillion, Amazon, which is I think just over $2 trillion, Google $3 trillion, Microsoft $4 trillion, NVIDIA $5 trillion. A data center is $60 billion. And those are one gig data centers, and they want to do 5 and then do 10. Numbers are astronomical. And so part of the war hypothesis is actually going to the unified, the allies of America. That would be Saudi Arabia. It would be the creditors, the Japanese, and saying, you guys are actually busted, but I need your help. And I call the cards because I'm the debtor. And so I've tried to expound and explain to you that the deal for Japan was the deal for Japan was, you have $1 trillion, which is, funnily enough, which is the equivalent of the US gold reserves, but you have got $1 trillion in holding in our treasuries, and we thank you for that, and we understand, and that was all part of our alliance, our allied pact from the Second World War. You're protecting our flank. But now we want you to, we want to jazz it up, and it's really good for you guys because we need so much money for this economic and hopefully not a military war, but we need so much money to prepare for this that we essentially want you to rehypothecate your treasuries to leverage them and actually be spending several trillion dollars, and we'll give you equity in the build and the rollout of automation in America. And at the same time, your current, like, we got to talk about your currency. It's fallen 40%. Now, previous administrations, we would be up your ass and we would be demanding that you sort things out. But we're friends around here and we're going to look the other way. We actually kind of like your currency weakness because it puts a lot of pressure on the enemy, our Chinese, our Chinese counterparties. So you scratch my back, I'm going to look the other way and I'm going to allow you to have the further currency devaluation. And your stocks, did I mention this week, the Nikkei, Japanese stocks on the weekly, the candle versus the previous week? Japan is just flying higher. Debtors and creditors. And the debtor, so all the power is coming to the debtor, America. Tariffs are, have been sold a bit like quantitative easing was sold as being the death of fiat. It was money printing. That tariffs would be inflation, which is the death of fiat. It's not the case. It's a tax. Treasuries, we talk about treasuries being asleep, but treasuries are at a 4% yield, down from 5%. I was reading some great comments from Treasury Secretary Besson explaining the Niederhofer rule. Our system does not work at 5% 10-year treasuries. We don't operate there because of the magnitude of the stock of debt. And so they are taking measures. So tariffs are tax, and it's an international tax. So you're widening the tax take of America now encroaches across frontiers. And the US economy is becoming the locomotive of economic growth. It's got a lot more that it can expand into than China, where all China can expand into, owing to a philosophical vice that it has. But all it can expand into is more and more exports. And its export surpluses are like over 1% of global GDP. And history just says, beyond that level, the other countries, the beggar, thy neighbor countries, they're like, we're done. We are done. The destruction of the European automotive industry. Some point, they go, we're done. We ain't trading with you. Anyway, wow. Where is this word salad coming from? So I'm not scoffing the Sinclair thing, but I think I'm saluting and applauding the fact that Jim Sinclair made $45 million and he called something and it came to pass and he had the discipline to cash it in. And then there's lastly, you're still vibing on the Paul Tudor Jones interview. And this is perfect for the podcast because I don't like science and finance. Let's keep it simple. Bitcoin is an alternative to gold. It should move on the same fear. So if you still have fear, if you still believe that you need... So again, we've got 55 years and the S&P has been a remarkably good hedge against fiat. Why do you need gold? Is outperform gold. Why do you need gold? Why do you need other hedges? It's very liquid. But, we put together, we've got this thing called the macro compass, and we can put together a quadrant of alternative assets. It's not just S&P and gold. You can have Bitcoin. And Bitcoin is just again, I'm sorry, I'm going to bore you. You finish my sentence. Bitcoin is, do I hear it? $2 trillion market in the context of, let's call it $300 trillion of financial assets. There are $7 trillion, for instance, in money market funds. And let's say Steve Miran notion of the neutral rate is way below 3. And then because the Fed's not going there quickly, we actually have a hiccup in US economic growth, which would not be pretty for the rest of the world either. So we have a pretty serious downturn. And short-term rates come to 1%. I mean, again, those of you who can and who have the expertise, look at putting just a tiny amount of your wealth or pricing it up. How much does some kind of option strategy where you try and buy an option on the Fed being at rates below 1% December next year? Am I saying that is the most likely thing to happen? I am not saying that at all. I'm saying that's remarkably unlikely to happen. But if it does, I believe that the return is something in the order of 25 times. So that's why I want you to look at that. Anyway, so that $7 trillion, which is presently getting a yield of 4%, that's nice. 4%, I think, is that like you double your money in 15 years? I'm making that up. Anyway, but if that's less than 1, that's money that goes into Bitcoin. Maybe they tip 10% in. It's less than $1 trillion, but wow, that has a big impact on Bitcoin or pensions. So the pension industry allocates on average 0.5%. It's we just don't have enough Bitcoin. Let's put 0.5% of our global assets, global or American assets, things like that. And Bitcoin is no longer a $2 trillion asset. It's a $10 trillion asset. And then you've got reflexivity and people chasing it and further allocations. And it's a $20 trillion asset and it's priced at $1 million. So for me, gold is no longer a hedge. I'm hesitating there because I did suggest there was kind of if gold, I was suggesting to you that maybe gold, the return from holding gold from 1970 will, at some point in the next 3 years, match the equivalent return from the S&P. And I was suggesting probably that comes from stocks falling more than gold. So in that sense, gold would be a hedge. Like a bear curve steepener. Not really sure you want it to happen. It's like, I'm going to outperform, but I'm going to lose absolute money. Doesn't sound great. And in the short term, I think gold is 25% above its 1-year moving average. So like for me, and Paul Tudor Jones again says, you run your winners. But if I had a big gold position, I would be more than halving it. So that I could maybe start feeding money back into it if it mean reverted, and everything mean reverts to the 1-year moving average. Anyway, I've gone on and on and on. This was your acid breath. This was your acid breath for October the 7th. It is a Friday. The weekend beckons. You're listening to this now in your weekend. My weekend will come. I will have 2 days where I do not do podcasts. I welcome that. But I promise you, I will return on Monday. And there will be no economic data. But there will still be disturbances in the universe. And I hope that you will join me and we will discuss more disturbances and what they mean for your wealth in the future. My great sincere love to all of you. Have a wonderful weekend and bring on Monday. Well, don't bring it on too soon, but bring on Monday. Bisous, 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 bisous from what has been actually very wet St. Bart's this week. Good night.